Hey everyone, welcome to another edition of Super Prime UK with your Super Prime valuation specialist, myself, Rob Cohen.
Myself, James Wild.
Today, super excited, we have a special guest. We have Michael Dean from Avamore Capital joining us. Very excited, great track record, so much going on in his life that he's going to be sharing with us. Not going to give too much away, stay with us. He's going to be sharing all. First, we'll start with you, James, and give everyone the update. What's been happening?
Thanks, Rob. So the market seems to be very much easing into 2024. Just in terms of some of the data we've seen so far, a very positive sale of the week last week, Rob. Just 19 million or so sale up in N2, Winnington Roads. Some good positivity there for the super prime market. New instructions last week, highest of the year so far, 377, which is again some sort of shoots of positivity. Under offers, 190, so quite a good pipeline there. The sold figures are 110 for last week. We're a little bit behind the average of what we saw last year, but like I said, we're sort of really easing into 2024 so far in terms of the sold figures which we're seeing there.
Yeah, I think love Winnington. A lot of people ask us in super prime world, is Winnington the new Bishops? And I think from a living perspective, it's more of a practical road to live in than the busy thoroughfare of Bishops.
I think you get sort of, in terms of sort of the vast size, you'll get slightly smaller houses on Winnington than the Bishop's Avenue. However, in terms of the end users and the occupiers, I think they're more, in terms of more typical own end users, whereby they're sort of lived in for a higher proportion of the year. It's a quieter road. It might not have the same synonymous high value nature that the Bishop's Avenue, but in terms of super prime, there's still some very large houses on that particular road, number of detached properties, basements, large gardens, so it really appeals to the ultra high net worth market still.
Yeah, I've said it on this show on numerous occasions, but I think Avenue Road is the 2024 version of the 1980s Bishop's Avenue, and Avenue Road is where the super home for the ultra high net worth is now being built and delivered, and that's a shift change in, let's call it, semi-North London ultra high net worth living.
Yeah, definitely. I think over the last sort of 10 years or so, there's been some of the consulates which have been sort of sold off or converted on the street as well. You have the big sort of detached villas there, and also the main thing is the plot size and the gardens on Avenue Road. You just get those executive homes, gated driveways, ticks a lot of boxes for the ultra high net worths and overseas buyers, those sort of price points. So welcome, Michael, to the show. Thank you so much for joining us, as well as being heavily involved with and being one of the co-founders of Avamore Capital. You also have your own podcast, the Property Funder, as well. So welcome, Michael.
Thanks both. Thanks for having me. It's a pleasure to be here and excited to have the conversation.
Great. So let's start off. I was just going to sort of start with the sort of Avamore Capital side. So can you give us just a brief introduction of Avamore Capital and how it all started and how the business has evolved?
Right. Well, I'll start maybe in the beginning, beginning of my career, and I sort of skip on. So I'm also actually a trained surveyor for my sins. Started out in commercial agency in Cushman & Wakefield 20 years ago. Sort of feels like yesterday, but there you go. And then around the time of Lehman Brothers, I ended up working in a private equity shop and spent most of the 2.5 years that I was there restructuring the debt on the investments that we had, and also procured some speculative development finance for what turned out to be a 210 million GDV scheme in Victoria, which is a mixture of offices and resi. I ended up working with my father-in-law after I left there. Basically, it was a bit of a lifestyle decision, and helped my father-in-law set up his family office. We helped him exit his main business as well, which is a healthcare business, and we reinvested that into real estate. Around 2014, 2015, we were fully invested in real estate, direct real estate. And so I had a bit of time on my hands, and I ended up doing, I suppose, some consultancy work with some developers who were looking to raise a bit of capital, raise a bit of equity. And as part of that, I ended up stumbling across Zahair, co-founder at Avamore, who'd just left Goldman. He put some money into some bridge deals through some of the platforms that were existent at the time. And I was trying to persuade him to put some money into basically a second charge for one of my clients who was looking to raise some funding. And he was pretty adamant that he wanted me to invest with him. We started talking about how we saw investment, how we saw the world. And then that's sort of how Avamore was born. And alongside Zahair, we had Nick Petkov, who was working for my family office at the time. And we were joined by Amit Majithia about six months later. And so that was the sort of the origin of Avamore. We got off to a pretty good start within 4 weeks of us setting the business up or incorporating the business. We actually did our first loan, which is to an existing client of mine who was looking for a bridge loan, and we got funding from a family office to fund that. But then Zahair and I essentially were funding the bulk of Avamore's loans for about 2 to 2.5 years. And then we started to bring in high net worth capital to co-invest alongside us in club deals. We saw a massive gap in the market, in not so much in bridging, but I think kind of more heavy refurbs and then into ground up development. Around 2015, 2016, you could see that there was a lot of money coming into bridging. I think it was the sort of the start of bridging becoming more institutionally institutionally more acceptable. And on top of that, you could get 1% a month from a high net worth. At 70 LTV, that was a very compelling prospect as an investor into that sort of space. And so very quickly, bridging rates started to go down, especially once you put institutional money into the mix, which obviously had a much lower cost of capital, considering that the base rate at the time was 50 basis points, obviously compared to the north of 5 that we experience today. So we saw a big opportunity in the development space, and so we were very active in ground up development, working particularly with early stage developers who, again, another arena where we felt that there was an underserved market. And so accordingly, we had an opportunity to fund earlier stage developers, less experienced developers, and help them get on their way and build their track records up so that they might be eligible to work with a Close Brothers or someone who's a bit more, someone who would be more open to working with a more experienced developer and maybe be a bit cheaper. After about 2.5, 3 years, we started to attract attention from institutional capital, and we were approached by a couple of US credit funds, and they wanted to fund our loans, and we've been working with them ever since, and we've done the best part of 600 or 700 million pounds worth of lending between our institutional credit funds and I suppose the third party private families. Avamore's really as a business is a development lender that does some bridging. So about 25% of our activity on any given year is bridging, but that typically isn't your rooftop bridging, 2 up, 2 down, semi-detached, chimney pots in Greater Manchester, out of London. Typically, it will be a bridging against a bungalow that developer wants to get planning on to put a couple of semis on there or put 9 apartments or whatever, or alternatively it's a development exit. But our single USP product, because I know this is a question you wanted to ask, is around Part Complete development. So we came up with the term finish and exit. The rest of the market then stole it. But ultimately, the finish and exit that the rest of the market sells is effectively it's a refurb of a nearly finished development. For us, Part Complete development starts with it's like the sort of golden brick. If you're in the ground or you're just coming out the ground, that for us constitutes a Part Complete development. And so we've done it's probably our most successful product in terms of profitability, and it probably our biggest loans that we've ever done have always been in that Part Complete development space, and it remains for me the proudest product for me that we offer. and for me, also the best product that we offer as well.
Yeah, and just in terms of your background, you mentioned about being initially a surveyor and having some property expertise in private equity and consulting. Has that helped you in terms of your own expertise, or looking in, and enabled you in the early days to have your own sort of mind from maybe a deal perspective and a credit risk perspective?
I think one of the benefits when we set up Avamore was that we had the benefit of being outsiders. So we never had I suppose what I think is the baggage that comes with this is how it's always done. So we've always taken a slightly different approach where we can do in order to be able to find innovative and new ways of finding solutions for clients and for brokers and borrowers. And so with that in mind, I think sometimes our ability to engineer deals could go a little bit too far. But for the most part, if a broker has a deal that is challenging or complex, we've always been able to rise to the challenge. We were lending against corporate transactions as early as 2016, 2017. Deals that, for $1 million or $1.5 million purchase. For most people, no one in their right mind should be doing a corporate purchase at that sort of level. The amount of stamp duty savings isn't worth the cost of the legals, frankly. But we were able to do that. We were able to do that for clients, and I think that ability to find solutions and be innovative, to be able to apply that higher standard of professionalism that I think is now mainstream and widespread within the specialist finance arena, but wasn't really there 6, 7, 8 years ago. It wasn't there as it wasn't as prevalent anyway. Yeah. So our ability to apply that degree of sophistication definitely gave us an edge. Yeah,
so definitely in terms of your innovation and strong internal expertise has really sort of helped to consolidate some of those products. I know you mentioned about your finish and exit product being your most popular.
I'm going to have to correct you there. It's Part Complete now. We don't use finish and exit.
Okay.
We rebranded it Part Complete because unfortunately the thing about finance is there's no real intellectual property. You can't patent these things or trademark them. So we had to rebrand it Part Complete.
Is it fair to say, just in general terms, a bridge exit is the less riskier end of development finance purely because you're virtually there and done with most of the build costs?
You mean from a Part Complete standpoint? Or I think the Part Complete development products that are offered by our peers, the finish and exits, the fake finish and exits, I would call them, they are effectively bridges. I mean, that's what they are. They're, and it's ultimately driven by the risk appetite, the funding lines that sit behind those lenders who they're not development lenders. They don't understand They don't understand development risk, and neither do their funding lines have appetite for that. So their approach is, if the developer doesn't finish this, am I at 80 LTV against what I've got today? That's kind of, I think, the mindset that they've got, and that's how they're able to get comfortable with it. But when it's half built, they can't do that. If it's not wind and watertight, for example, they just can't get their heads around it, and so they back off, they shy away from it, because I think they're just not geared up to deal with approaching the credit risk on subsequent drawdowns.
I think from a liquidity perspective, anyone understands that to exit a development scheme that is maybe far from completion is the least liquid position generally you could possibly find yourself in on a lend, and that's always the biggest challenge with the development finance.
I think that's 100% right, because you've got to think about your pool of buyers. Your pool of buyers at the beginning of when a development site hasn't been started is anyone who would do that development. The pool of buyers at the end is your end user, which is obviously much greater or much larger market. There are very few developers who want to step into another developer's shoes when the building's half built. So, and look, we've experienced it a couple of times at the moment with stuff that's on our books where our borrower has not performed, and we're effectively having to manage the situation out. Now, we've got good enough in-house expertise. Our new director of credit, Matt Foley, who's joined us from Octopus, he's got a lot of experience in that arena, very comfortable making, I guess, quote unquote, difficult decisions. And I guess that's kind of in our minds where we earn our corn in this difficult market. So how do we sell ourselves to, say, future funders and also prove ourselves to existing funders? It's our ability to manage out these difficult situations to the extent that we're now taking over loans for our existing funding lines from effectively failed lenders. So lenders who our funders have backed, who have effectively failed, and we're having to help fix those situations.
That's a great opportunity for us after the show. We've got a really good debt recovery arm that works very closely with lenders. So off camera, happy to discuss that further.
Okay, brilliant.
In terms of the lending policy from more of a mainstream perspective, it's become a lot more stringent with sort of the likes of warranties, professional consultant certificates, and the like, just to facilitate the sort of end product mortgages to the ultimate buyers, the end users. Has that sort of required any sort of close management internally? Preferred warranty providers or PCCs?
We have a very close relationship with J3 Advisory. I would say close relationship. Jack Bristow is a close personal friend, and I've provided him with a lot of mentorship. And I wouldn't say he's given me mentorship, but I certainly get a lot of inspiration and excitement talking to him. So I think from the warranty perspective, if we ever have any question marks around a development or around a deal that we're looking to get into, whether it's part complete or at the beginning, we typically Jack will get a phone call from one of the team to pick his brain on things, and he can give pointers. Likewise, we'll speak to solicitors who are independent of our panel, and ask them. So, for example, David Hirschkorn at Jolson, who it doesn't necessarily do much on the lending side for Avamore, but does a lot for me personally, or say for our family office. I'll speak to David or his colleague Michael Friend, and I'll say, look, can I just run you through the situation? What do we need to do here? What are we missing? What would you think is important? What's a high street conveyancer going to need to see to be able to sign this off for their end user and their end user's mortgagee? Those are the kind of things that we're doing. But we won't have a checklist necessarily. I think you have to apply a case by case approach.
Very bespoke approach. Great. And then in terms of, you've mentioned about your development lending products. In terms of the ground up development, it's maybe not your core area, but it's something that you sort of regularly get involved with?
I think to say it's not our core area is probably not entirely accurate.
Yeah.
I think we would very much like it to be at the front and centre and our biggest product of the mall that we offer. I mean, I would say, I would maybe slightly disagree with myself there, but I would say I much prefer Part Complete, just because I think I just think it's such a great product, because you get rewarded with development returns, but you're really not taking full degree of development risk, because let's say the groundworks risk is taken.
Yeah.
Notwithstanding that though, that size of addressable market versus the size of the development market as a whole, I think typically there's about 24 billion of development lending that goes on in the UK every year. There's about somewhere between 5 and 6 billion of non-regulated bridge lending by comparison. So for us, the attraction to go into development, or for development to be our most dominant product, is 100% there. So we're doing ground up deals month in, month out. We'd very much like to do more than we currently are. I mean, there are issues at the moment with, understandably, if you're a developer right now, your appetite for doing ground up development, especially last year with, I suppose it's sort of what you call it, quadruple whammy of land values not really moving, your build costs going up, GDVs going down, sales velocity going down. Why would you start a ground up development last year if you didn't have to? It just doesn't make any sense. But I think in the long run, that's very much where we want to be going as a business. And I think the challenges that we and many in our market are facing is that ground-up development lenders want to lend, but we're having restrictions imposed on us by our funding partners who have a slightly different set of priorities, and so they are more cautious in their outlook at the moment. They want to maybe hold things back. Now, my message to them would be, I actually think right now is going to be a really good time. You're going to be lending into ground-up development, because I think you're going to have some great. It's going to be a great vintage, if to use a sort of private equity expression, because I feel like build costs are now starting to moderate, if not go into a slight decline. Okay, land prices are starting to soften a bit, but not massively. But let's not worry about that. But I think the lack of new supply that's coming through means that, and we can talk about interest rates as well. I think interest rates starting to soften. I know we've had a bit of a hiatus on that for the last 6 to 8 weeks since the start of the new year. But I think in the long run, or the medium term, I think interest rates will start to soften. And so I think what you'll find is that anyone who's sticking a spade in the ground right now, 18 months from now, when you're coming to sell those units, you're going to be very happy with the outcome. It's going to be a great performance for you as a developer, and therefore as a development lender, that feels like this is a bit of a green light signal for me to be active in that space. But I think it takes time for that to filter through to the funders, the people that fund lenders, for them to sort of get on board with that. And there's also kind of other competing factors. We're funded by American funds. They look at what's going on in the States. That we could also see a big change as well, in that as soon as the funding market in the States comes back to life, which it's starting to, there's more competition for capital over there. So they then need to find places to deploy the capital, so that more money will come to the UK as a consequence, because obviously the UK is still seen as a very attractive place to be deploying capital into the real estate debt space.
Just to add another point, I agree with your outlook. I'm also relatively positive. Just the challenge in your space is, with the developers, the cost of development finance and borrowing, because of what the debt markets have seen over the last 12 to 24 months, is another key variable that's eating away at profit margins, and they do need to see that change, or for them to get more comfortable with the variables going in a positive direction before, as you said, putting that spade into the ground.
I would challenge that, in the sense that, yes, we've obviously seen a big rise in the cost of development finance, but your finance cost as a proportion of your total cost as a developer are still still a relatively small proportion of your total costs when you're a developer. So I think as a consequence of that, yes, it feeds into it, but I don't think the cost of development finance moves the needle for 80% plus of all developers as to whether they go ahead with a scheme or not. If you're reliant on 8% or 7% or 6% cost of finance for your development finance as a developer, you've probably got bigger problems, because you've not managed your construction costs, or you're paying too much for the land. That's ultimately the way I would see it.
That's it. Great, thanks, Michael. And then just in terms of the background of some of your sort of developer clients, is a lot of the land something that they've either land banked over a long period of time, or is it something that they're sort of a turnkey development site which they're acquiring?
I think it very much varies from developer client to developer client. For the most part, I would say that they're developers that are just picking up a ticket.
Yeah,
they've been able to source a site off market. Off market, we all know what that means, but you know what I mean. They've been able to source a site that they've been able to access. It's got consent, and they're just stepping into someone else's consent, buying the land off someone that's done the work on the planning side. Having said that, though, probably our most successful client is a chap called Mihir Mehta. I had him on the podcast. A very interesting guy. He used to be a planner. So he started out as a planner in a local authority, and then started moonlight the second half of the week, because he was working flexi time, advising clients. Then he started to, buy his own sites and get planning and trade them on, and then he moved into development. And so we've done, approaching £50 million worth of lending with him, just him alone, and he he's securing the sites well in advance. He's either getting them on options or he's buying the sites unconditionally, mainly on options. Obviously, making a bit of a nice spread on the land on purchase, because obviously what it's worth and what he's contracted to pay for it, there's obviously a bit of separation there. And then he's building the sites out, and then he's retaining them. So you do have people who of that nature who do that sort of thing. But I'd say for the most part, most of our clients are people who are buying sites with consent.
That's it. I think with the developer clients, it's those which sort of know the process, have the expertise, know when they can upscale any planning, and obviously those which can obviously deliver the housing. That's the real sort of sweet spot, as they've got sort of a full spectrum of services that they can work up, different styles of developments, whether it be the turnkey, have a land bank, and have the full spectrum. Just taking a step back for anyone that's listening and maybe isn't familiar with the term ground-up development, I don't know if we can just explain a little bit more about some of the nuances between those products.
Of course. I mean, put simply, ground-up development is essentially when you've got, well, it can either be a brownfield site or a greenfield site. A brownfield site is a site that's been built on before. A greenfield site is essentially, you could call it a field, for example. It's effectively virgin land that's never been built on before. But the key thing there is that the key distinction between ground up and, say, a heavy refurb is a heavy refurb might be you have an existing structure which you're extending or converting to some extent, whereas and you could have new build components to it. So parts of that existing structure which have land that surrounds it, and then you're building on that. That would not really be ground-up development. That's still what we would classify as heavy refurb. Whereas ground-up development would be you have a site, you clear it, you put the foundations in place, you put the superstructure on it, and then you put your roof, your windows, you do your first fix, your second fix, and then you do your Cat A, your Cat B, and you put it on your landscaping, you put it on the market. So that's the I suppose the key distinction. I don't know if that's
that's brilliant.
Well enough for you.
No, I think that explains to everyone that maybe it isn't as familiar with this sector. Just in terms of looking forward now to the rest of the year, 2024, is there any new lending products coming online, or any sort of growth areas which you're really targeting?
I think the key areas of growth that we want to be focused on is very much just doing more in the ground up space. We announced second half of last year that we'll be doing purpose-built student accommodation, or PBSA. Some people don't quite know what that is, but PBSA. But we're not going to be doing ground up in PBSA space at the moment. Funding lines don't have appetite for it, but also we think that there's a good niche in the market for us to exploit there, where we're looking at repurposing, I suppose, first generation student accommodation, and bring that back in, bring that up to modern standards, or taking, say, commercial buildings, particularly in locations in the north where perhaps C3 residential doesn't generate the capped values per square foot that, say, student accommodation will. So we'll be working with developers to developer operators in the PBSA space to help them convert those buildings into PBSA.
It's definitely a space that's evolved the last 10 or 15 years, where universities aren't so tied to producing their own in-house accommodation, have gone into the private sector for companies to be able to facilitate a more sort of higher spec student accommodation. And obviously there's been an uptake in the students that were willing to pay for that, which creates the market.
Yeah.
We had the CEO of the Association of Short-Term Lenders, Vic Janos, which I know you're a proud member of, and he was sharing with us strong data from 2023 of one of the best performing years in the short-term lending space, and how he very much expected that trend to continue into 2024. Do you have the same outlook?
Well, first of all, I wouldn't share his enthusiasm for 2023. I think some of the I'm maybe a bit skeptical of the data, because we saw our new origination volumes last year drop not, it was still our third best year on record, but notwithstanding that, we still saw a drop in our new originations. I think one of the challenges we have is that we don't know what other members are presenting to the ASTL as far as their data is concerned, and what they classify as qualifying and not. So I always find that a little bit difficult.
Sorry to interrupt. When the retail lending market is so challenging, like we saw last year, and the gap between short-term lending and mainstream retail lending has probably come down to its narrowest point that I can remember, then it does make sense that more people would come into the short-term lending space, whilst there's so much volatility, which we saw last year with interest rates and the product that is available on the mainstream market there. That seems to make sense from my perspective.
I would agree with that. I think we still saw a lot less of it than one might have expected. It's probably, I think what we do see is that most people who are in the let's say if you're a buy-to-let investor and you're coming off your 3%, your 3.5%, and now you're staring at 7% down the barrel, or you could go to a bridge lender at, I don't know, 8, 9, 10%. 8 last year. If you got 8 last year, well done. But 9, 10, and then some. But the difference is, of course, that there's no ERC, and if you're getting your crystal ball out and you think, okay, well, interest rates are going to start falling, and maybe I'll be able to get maybe not a 3.5, but maybe a 4.5 in 12 months' time. I'll sit on this slightly more expensive rate, but I'm not locked in for, I don't know, 5 years at 7 or 6.5, or I'm paying 6, but I'm paying a 5% product fee, or something crazy like that. So you'd think that would be the case, but still, notwithstanding that, and we did see some of it, we didn't see anywhere near as much as we would have expected of that. For this year, in terms of enthusiasm and positive expectations, I think we will see. Don't think Vic's wrong to be optimistic about this year, but my view will be that we're more likely to see people return to the buy-to-let space and acquiring more assets for private rental. Obviously not the amateur investor, but will be the professional investor, because I think the opportunities are there. Obviously the rental growth is very strong. House prices have been, they haven't cratered, but they're not, they're kind of a bit anemic. But yields are more attractive. So I think you'll start to see people coming back into the sector, but I think it's very much reliant on interest rates for term products being at levels where there is a positive yield gap between the interest rates, between the yield on the property and the interest rates payable to a term lender. When that comes back, because if you're buying a property for refurb, the BRR, what BRR, however many R's you want to put on it, but build, buy, refinance, buy, refurb, refinance operator, you might be able to buy the property at an attractive price. You might be able to do the refurb, but if you can't refinance it at a price that gives you that positive yield spread and enables you to take your initial capital out of that property, and that's been the other issue. Obviously, it's been leverage, and part of the leverage is obviously something that's driven by if you've got higher interest rates, you've then got your ICR covenants. So if your ICR covenant is busted at, I don't know, 75, 80, 85, whatever you were able to get before, and now you're having to be at a lower LTV, more of your initial capital stuck in that property in the long term. It doesn't work. These guys in the office, they're churning, aren't they? They're churning all the time. They can't do that. So I think we do need to see a fall in those sort of medium-term interest rates to be confident that sort of the refurb bridging market, which I think was carried us the last 13, 14 years, for that to come back.
Yeah, and just in terms of what you mentioned there, the PBSA, the purpose-built student housing, is that maybe opening up an opportunity to do more residential investment loans and deals and maybe entering into the build-to-rent space?
I think build-to-rent will be a way off, because I think there's to be able to lend into that market, the dynamics of that market, you often have pension funds that are effectively forward funding those, forward purchasing or forward funding those schemes. So the only way to be active in that market from a lending perspective is to sort of be at a slightly awkward ticket size that those institutions don't want to be operating at. Then begs the question, who's your exit to? So it's not that attractive, I think, in that respect. In terms of residential investment lending, I mean, I have a very strong personal view as one of the major shareholders in the business. Still, having slightly influential voice, but we have a CEO and management team that ultimately run the business day to day. The advice I give them is the same advice I give anyone in a smaller business, which is you need to be focused, and you need to be the best at the thing that you're good at.
Yeah.
And I think that we've still got, we're very good at what we do, but I think that there's so much market that we could be hoovering up in the development space, that going into a very crowded market, when you call it residential investment, I mean, let's just call it what it is, it's buy-to-let, right?
Yeah.
The buy-to-let market obviously is massive, but also it's ridiculously crowded, and it's a very price-sensitive market. So how do you differentiate yourself in buy-to-let? Frankly, there's only one real way, or two ways, which is price and leverage. You've got no other real levers to pull, in my opinion. On the very fine margins, you could say service, but in development finance, you could be a whole 50 basis points, 100 basis points more expensive than your peers. But if you're giving developers drawdowns on time, if you're providing an extra degree of service, a layer of service that they couldn't have, if you're able to put mezzanine or equity options in front of your clients, you are in a much stronger position. And that difference of being a little bit more expensive is because as I was saying earlier, it's a very small piece of the total cost for a developer. And if you're charging an extra 50 basis points or 100 basis points over 18 months across a project, but you've introduced the client to an equity source or a mezz source that unlocks the deal for them, that's a tiny price to pay. And so, I think that's where the opportunities will lie for a business like Avamore.
Yeah.
And that's what I say to any entrepreneur: put all your time and energy into the things that you're good at, or you can be the best at, rather than trying to be an also-ran in a big market.
And just to follow up on that, in terms of the HMO space, if you like, or heavily adapted, is that something which you're also sort of heavily involved with in terms of some of your lending products? Yeah,
we look at that space or that sector regularly. We lend to the sector. I suppose we're sometimes guilty of applying too much of a sort of development lender's lens on these things. But we have lent to the sector. For us, it's very much about, we'll be quite client driven in that, if we're lending against that kind of project or against that kind of product. And we'll also have an eye on, we'll always be looking, say, at the VP value rather than the investment value. So, there's what you call it, where you would say, talk about heavily adapted HMOs, whatever you want to call it. We're probably better in the south, where, VP values, the difference between VP value and the investment value isn't that great. I think when you start to go further away from London, the southeast, and you start to see a bigger disparity between investment value and VP value, there are probably better lenders out there for that type of product.
Yeah, and there's definitely a bit of an emergence in that market of more sophisticated HMOs, which sort of offer a more sort of higher specification living, if you like. So it's going to be interesting how that develops, and if that sort of generates differing yields from the remainder of that sector.
Yeah, I would agree with that. I think, look, you're the valuer, so you can, you ultimately be the ones that drive some of this. But look, fundamentally, consumers, renters are consumers. The consumer expectations are increasing. They're getting greater. I think people from that sort of what you call generation rent, especially as those renters are starting to age up as well, because they can't get on the housing ladder, say compared to someone of my age, my generation, I'm only in my early 40s, those expectations are going up, and I think as a consequence of that, they will want better quality products, and they'll be willing to pay for it.
Great, no, thanks, Michael. And then just lastly, in terms of green mortgages, these are becoming far more popular. Are you seeing this expand at all into the challenger banks marketplace?
Well, I obviously can't speak as a challenger bank because thankfully we're not a bank. But notwithstanding that, we're in discussions with a couple of new funding lines. We have been for the last couple of years. And one of them is incredibly ESG focused. I mean, at the end of the day, we are, as an organisation, we're taking the move into ESG very seriously. I mean, at the end of the day, whether we believe in environmental stuff or not, it's a smart business decision because that's just the direction of travel. And so we haven't at the moment got the ability to offer, say, discounted products. If someone is able to improve the ESG scoring of a property or the EPC rating of a property at the moment, but at the same time, we also have to we have to acknowledge that the EPC rating of a property is going to have some material bearing on the end value of it pretty soon, as let's say you won't be able to rent out a property if it falls below a certain threshold. So consequently, just I suppose from a credit perspective, that's important to us anyway. But one of the new funding lines that we're working with, one of the things that we had discussed with them was, and we will continue to try and push for that to become reality, is that to be able to offer cheaper cost of capital for people who are improving the energy efficiency of properties, as one example.
I'm loving that, Michael. What are you looking to do in the coming year with the show?
Well, I think I think first and foremost it's more of the same, but I think we're going to look to increase production values. So we're going to move to more in-person recordings rather than doing recordings over Teams. So I think we're looking to grow the YouTube following, probably make more effort online, help Avamore leverage the show better as well. Working with Kimberly, our new marketing coordinator, to take advantage of that. But also we just want to expand our reach so that we can get more exposure, bigger guests as well, maybe some more people from outside of the industry, but also some of the bigger names within the industry. So some of the people that we're talking to at the moment, I'm very excited about. So trying to get people that are guests on that are going to excite a wider audience from within the specialist finance and property sector. But certainly, but put it this way, I'm loving the experience that we've got at the moment. We're 40 shows in, 40 recordings in. Not quite the 140 that you're at, but we're nearly there. We'll be there in a few years' time. If we're still doing it 4 years later, like you have been, it will have been a massive success, and it will have smashed all of our ambitions. Certainly, I never expected to be making a living or making money from the podcast, but one of the things that we've done this year, which was really exciting, a couple of weeks ago, we had an alumni dinner, so we're creating a community of podcast alumni, and we're looking to grow and expand that as we add more and more guests on. So it's a sort of nice way of giving back to our guests. We're also looking at doing as well, maybe it's more of a 2025 ambition, is to maybe do some sort of half-day seminar or conference where maybe focused within either specialist finance or property, or it could be just entrepreneurship more generally. And as we continue to build a community of guests, but also a community of listeners and viewers, bringing them together under one roof in person for a sort of in-person experience that will be, I suppose, complementary to not just the podcast, something that Avamore can benefit from, I hope, but also more importantly, the community of our audience and our guests can participate in together and continue to benefit from.
Loving that, keen to follow and see that happen.
Thanks, Michael. So I know you're a big sports fan, and the Super Bowl at the weekend, the Super Bowl, most watched US broadcast since the Apollo moon landing. Phenomenal statistic there. I think you watched earlier in the week?
I did actually. I didn't watch it live, thankfully. So yeah, my bags are that's genetic, I think, under my eyes, not still recovering from my lack of sleep from watching the Super Bowl. I watched it on record. Had the results spoiled for me, but no. Huge event. Super Bowl was probably one of the most exciting Super Bowls I've watched for a while, and yeah, those viewing figures. You can't knock the power of Taylor Swift and her Swifties, right? It's not my brand, not something I'd necessarily choose, but yeah, she's a dream come true for the NFL in terms of her ability to draw a big audience.
That's it, the power couple. And just in terms of football, I think you're an Arsenal fan?
I'm a long-suffering Arsenal fan, much like Rob, and a season ticket in the clock end upper. So yeah, have been season ticket. This is my 10th year as a season ticket holder, and have been. It's not been the best 10 years, although the last couple have been quite fun.
Yeah, it was great title to charge last year. Arsenal there or thereabouts this season. Are you sort of third at the moment? Do you think you can maybe push the top two?
My instinct is we should probably finish above Liverpool. I think we're a better team. We've got a better squad than Liverpool. I think we're a better team than Liverpool, as the result from a couple of weeks ago proved. But it's a bit like the Avengers movies. Thanos. That Thanos quote is, "I am inevitable." Man City are like Thanos, aren't they? They just have that inevitability about them. That even with the fixture congestion that they're likely to experience, they've got such a big squad, so much talent, that it's just impossible to look beyond them.
Well, Arsenal, the only blemish on Liverpool's form in the last 5 matches, the only loss. Obviously, Liverpool sit top of the league. City just behind, 2 points behind, but a game in hand. The only team 100% record in the last 5 for Man City. Just at the time, we got Kevin De Bruyne and Haaland returning. Like I said, Arsenal there or thereabouts. Man United still in touching distance of a fourth, just about. Spurs are also unbeaten in the last 5, coinciding with the return of Jamie Maddison and Richarlison also in form for them. Just Villa starting to dip off on their form, so we'll see how they make up the sort of fourth to 7th.
Yeah, I think having seen Unai Emery at work at Arsenal, ultimately, it's not surprising that Villa will start to sort of end up in around the 7th or 8th mark as the season progresses.
Yeah, and they're probably the surprise of the season so far in terms of where they are in the league post-Christmas. But also sort of Chelsea lingering at the moment in 10th, Newcastle having a fall in their form.
As I was saying to you earlier, I think that Newcastle's squad is ultimately a little bit too thin. They've obviously tried to build themselves, in an FFP compliant way. And I think some of their attempts to bolster their squad with loans from the Saudi league have come under a lot of scrutiny and have perhaps dissuaded them from going fully there. With regards to Chelsea, look, they've paid too much money for a lot of players that are probably a little bit mediocre. And I think if you want to be at the top in the Premier League, you need to have a strong squad, a settled squad, and you don't want to have 6 players in every position, as Chelsea seem to do, so they don't have much squad harmony as a consequence of that.
Yeah, Man City's the first team to win it 4 times in a row.
I don't want that to happen, but you just can't see past it, can you? It just seems to, right now, it seems inevitable. I pray it's a red and white win, but you just don't know.
Fraudiola no more after the treble win last year.
Let's see, you never know. Sport is unpredictable, so you never know. Let's see what happens. Michael, it's been brilliant having you on the show. Great insight, great value add, great journey so far. Loving everything, Avamore, loving the podcast and the community work. Keep it up. Super inspiring and super motivating. And thanks everyone for listening, watching, subscribing. Super Prime UK. Super excited for 2024. We're here for you, and we will keep providing you with everything that's happening on the ground and out there within both the property and lending market. Thanks a lot, James. Great intel as always, and we'll be back with you all soon. Thanks, James. Thanks, Michael.
Thank you both.
Thanks, Michael. Thanks, everyone.